Hello traders, investors, and crypto enthusiasts. Welcome to our channel, where we deliver deep dive analyses, hot news, and reliable projections about the blockchain universe, Web3, and digital money trends. Today, we re-diving into a critical market movement. Bitcoin bounced back to $106,000 on Monday, after briefly dipping below $98,500 on Sunday, the first sub-$100,000 move in 45 days. This recovery signals resilience amid geopolitical chaos, especially after President Donald Trump's full ceasefire announcement between Israel and Iran. But questions linger. Can BTC breach $110,000? Or will Middle Eastern tensions drag it lower? We'll dissect the technical signals mining hashrate drops, and how altcoins like BTC Bull Token and Virtual Protocol could react. Plus, we'll explore why institutional buyers remain bullish despite short-term volatility. Bitcoin's $106,000 rally, institutional demand versus geopolitical FUD. Bitcoin's rapid rebound to $106,000 highlights its role as a safe haven asset in turbulent times. Despite Sunday's dip to $98,500, BTC recovered within 24 hours. Fueled by $1.1 billion in ETF inflows from BlackRock's IBIT and Fidelity SY's Origin Bitcoin Fund. This aligns with historical patterns. During Russia's 2022 invasion of Ukraine, BTC rallied 30% in weeks, while traditional equities slumped 5 to 7%. Today, the trend repeats, but with a key different spot. BTC ETFs now hold $60 billion in AUM, providing a structural floor for corrections. The hash rate drop of 8%, from 943.6 meters per second to 865.1 meters per second, initially sparked fears of mining instability. However, analysts like Murray Rudd argue this isn't unusual. In April 2024, severe storms in Texas and Oklahoma caused a 27% hash rate crash, yet BTC recovered swiftly. The current decline likely stems from seasonal energy shifts and U.S. miner adjustments, not geopolitical disruptions. Still, whispers persist about unregulated Iranian mining operations, which may consume 2 gigawatts of electricity annually, though data remains unverified. Trump's ceasefire announcement calmed markets, but risks linger. With Israel-Iran tensions unresolved and oil prices fluctuating 7%, traders must balance BTC's macro resilience with short-term volatility. Tools like Glassnode SMVRVZ score derivatives market stability, liquidations, and open interest amid volatility. Despite BTC's 4.4% plunge over 12 hours last week, the derivatives market remains stable, a stark contrast to 2023's $150 million liquidation frenzy after the Fed raised rates to 5.5%. This time, $193 million in long liquidations occurred, representing just 0.3% of total open interest. The remaining $68 billion in OI stayed flat since Saturday, indicating institutional buyers are holding positions. This stability reflects improved risk management. In 2024, ETFs absorbed $1.1 billion weekly, creating a buffer against panic. Meanwhile, funding rates on perpetual futures turned positive, signaling renewed bullish sentiment. Traders using SnorterBot, a Solana-based AI trading tool with $1 million in pre-sale, avoided heavy losses by filtering rug pulls via its Scam Shield algorithm. However, the derivatives landscape isn't risk-free. The CMF remains negative, hinting at lingering bearish pressure. For BTCBULL holders, this is critical. The token's auto-liquidating contracts rely on BTC maintaining $100,000 plus as airdrops freeze below that level. Investors should monitor Glassnode's realized cap, which recently crossed $1.5 trillion, suggesting long-term holders are accumulating. Hash rate drops and miner behavior. Did the Israel-Iran conflict disrupt mining? The 8% hash rate declined from 943.6 meters per second to 865.1 meters per second, raised alarms about mining disruptions. While some speculated Iranian operations were affected, historical data shows hash rate volatility is normal. In 2023, Texas's 40% energy shortage during winter storms slashed hash rate 25%. Yet BTC rallied 30% post-recovery. Today's drop mirrors seasonal adjustments, not geopolitical fallout. Analysts like Daniel Batten note that miners often shut down during U.S. grid stress, prioritizing energy needs over profits. The April 22nd storm in Texas, which spawned 17 tornadoes, forced temporary halts, but operations resumed once power stabilized. Similarly, the current decline may stem from U.S. miner reconfigurations, not Iranian blackouts. Still, unverified claims about Iran's unregulated mining persist. Estimates suggest rogue operations could consume 2 gigawatts annually, but without transparent data, these remain speculative. The real threat lies in centralization risks. 10.000 wallets control 80% of BTC supply, per sentiment. If geopolitical shocks trigger mass sell-offs, the market could face cascading dumps. For traders, this reinforces the need for cold storage and multi-chain diversification, seen in projects like Virtual Protocol, which integrates AI agents to reduce reliance on single blockchain risks. Market reactions. How altcoins like BTCBULL and Virtual could benefit Bitcoin's volatility creates ripple effects across altcoins. The BTC Bull Token, which rewards hodlers with BTC at price milestones, surged 12% post-recovery, with $7.3 million in presale. Its deflationary mechanics buybacks via BTC reserves, mere frax finance, but its $0.00258 price makes it accessible. Hodlers buying below $0.00257 could profit if BTC tests $110,000. Though a breakdown below $0.002 would signal panic. Meanwhile, Virtual Protocol, rebranded from PathDAO, benefits from BTC's resilience. Its decentralized AI infrastructure, used by platforms like World Mobile and Ondo Finance, thrives when institutions rotate into utility-driven tokens. With $1.2 billion market cap and Coinbase listing rumors, Virtual's $0.0003 price offers asymmetric upside if BTC stabilizes. However, memecoins like Fartcoin and Pepe remain fragile. After hitting $1.5 billion in December 2024, Fartcoin crashed 50% in January 2025, proving FOMO-driven rallies lack sustainability. Investors should treat these as higher-risk plays, allocating only 1 to 2% of portfolio and using stop losses at 20% below entry. Federal Reserve and oil prices. How macroeconomics drive BTC's next move. The S&P 500's 1% gain in oil prices retreating 7% on Monday's signal trader optimism about Fed rate cuts. For traders, this creates a buy the rumor, sell the news scenario. If the Fed cuts rates in Q3 2025, BTC could test $120,000 as projected by ARK Invest. However, oil as $77 peak on Sunday and subsequent 7% drop highlight how energy prices impact BTC's volatility. Historically, BTC's negative correlation with JPY and positive correlation with oil mean macro shifts must be tracked closely. Projects like BTC, BULL, and CRV are poised to benefit. BTC, BULL's BTC airdrops accelerate above $100,000. While Curve's $12 billion, TVL and VECR VAP are of 8 to 12%, attract yield seekers. However, traders should avoid over-leveraging, as $193 million in recent liquidations show risks of blind FOMO. Investor strategies, balancing BTC exposure and altcoin allocations. With BTC at $106,000, traders must adopt frameworks balancing risk and opportunity. 1. Conservative strategy. Defend against further downside. BTC. Hold if you believe in its role as a reserve asset, but use stop losses at $95,000. Stablecoins. Shift 10 to 20% to USDC for liquidity during panic. ETFs. Monitor IBIT and Fidelity ETF inflows. If institutional buying resumes, BTC could stabilize. 2. Aggressive strategy. Trade the correction with precision. BTCBULL. Buy dips below $0.00257 for leveraged exposure to BTC rallies. VIRTUAL. Accumulate near $0.0003 with stop loss at $0.0025. Targeting $0.0005. Stop losses. Protect gains with tight stops on meme coins like Fartcoin and Pepe. 3. Hedging strategy. Balance BTC with DeFi and AI projects. Allocation: 50% BTC, 30% altcoins. Why BTC ETH offer downside protection, while BTCBULL provides leveraged upside. Risk management: rebalance quarterly to maintain exposure. The key is timing and discipline. Even in bear markets, projects with solid infrastructure and clear utility tend to recover faster, like BTCBULL and Virtual. Conclusion: Bitcoin's resilience in 2025. End of the road or new financial dawn? Bitcoin's return to $106,000 ISNT, just a technical milestone at S, a stress test for the entire crypto ecosystem. A failure to hold this level would validate bearish cases, dragging altcoins like SHIB and Pepe lower. However, a rebound above $110,000 could reignite the bull cycle. With ETFs and macroeconomic shifts as catalysts, for our viewers, BTC, maintain a core position but trim exposure if RSI breaks below 50 EP. Watch for $3,200 resistance, if broken, could outperform BTC. Meme coins. Treat them as short-term trades, not long-term holds. What do you think? Will BTC stabilize at $106,000? Or is this the start of a deeper correction? Share your views in the comments. Don't forget to subscribe for real-time updates and join our live streams, where we dive deep into charts, news, and blockchain trends. Remember, crypto investing requires research, discipline, and patience. Bitcoin might be a stellar bet, but always assess your risk profile before acting.
IBIT.
Until next time, may the market treat your trades kindly.